Welcome to today's presentation. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia, a registered investment advisory firm working with Australians and Americans in Australia. And today I'm talking about avoiding the super tax trap, US tax rules for Aussie retirement accounts. Okay, so of course, this does not constitute personal advice to you. This is general advice, and I provide specific personal advice to my clients. And also, I wanted to make mention of our YouTube channel. Without fail, every month someone says, is your presentation going to be recorded? They always are. And you can find them here, including last month's presentation, The Art and Science of Determining How Much of Your Wealth to Hold in the US versus Australia. So please subscribe to the channel if these topics are of interest to you, and give us a thumbs up. It really helps the channel out. A little bit about me. So I'm a financial advisor, as you would have gathered. I was really born into this situation as a tri-citizen, born in the UK, raised in Australia, and spent the last 20 years living in the US. Although I'm not in the US right now, I'm back in Brisbane, visiting family and friends, having a wonderful time. Just got back from Kakadu last week with the kids. That was a wonderful place. Moved to the US in 2005. Spent some time in the Bay Area working in corporate finance. And it wasn't until 2009, or actually 2008, late 2008, started my certified financial planning course studies, and really just found this was my calling. This is what I should have been doing all along. But for various reasons, I did not get started in that straight out of university. I founded the Global Financial Planning Institute with Matt Gorin in 2020, and we actually train other financial planners in what they need to know working with clients whose financial lives cross borders. So we host conferences for financial advisors. We teach them. We partnered with the US FPA, speaking with the CEO of the Canadian FPA in a couple of weeks. And we also work with the Investments and Wealth Institute in the US also. So that's a little, and I'm a frequent conference speaker. I'll be speaking in Minneapolis in October at the XY Planning Network meeting. And no doubt there will be others soon to follow. So kinds of clients we work with, you see three client types right here: the Aussie business owner living between Australia and the US, the high net worth Aussie family currently living in the US, and then the Australian executive who's permanently relocated to the US. They all had different goals and we achieved different outcomes for them, but really our services make sense for clients who have incomes, I'd say in excess of 350,000 US dollars, and minimum investable assets of $750,000, and they're looking to have that confidant, have that trusted advisor that they can pick up the phone and talk to and say, hey, this is something that's happened. I want to get your read on the situation, and can you help me with this and my overall financial life? That's where we come into it. But that is all an introduction leading into today's presentation. So firstly, we're going to start with, why are US persons still considered US tax residents if they live abroad? This is a key thing we need to understand in this whole conversation. Then we'll go into superannuation in more detail, tax treatment of superannuation by the US. That's actually going to be pretty brief, but well evidenced. So I hope you'll be pleased to see what it is I'm presenting to show why we hold the views that we do, and then some frequently asked questions. But before that, someone has chatted in. Jenny Wilkes. Ashley, there is a doing business in the USA event here in Brisbane. Oh, if you're still here. Great. Yeah, please do sign me up. AmCham. Cool. That would be great. First time I've been prospected while doing my own webinar. So that's funny, but that does sound interesting. Okay, so let's get into that, shall we? So a prospective client example. This is just someone I had in mind as I was preparing the content for today. So a prospective client based in Dubai, they've got assets in the US, UK, and Australia. They want assistance coming up with a plan to streamline their assets for optimal tax and investment returns when they plan to retire to Australia next year. Concerned about the changing rules for non-doms in the UK and the US estate tax issues. Really, the US estate tax, you've got to be worth quite a bit of money presently for that to be a concern, given that it's at 3.61 million per person. That's due to sunset at the end of 2025, so we'll keep our eyes on that. But anyway, the reason for showing you this is just to say this is the kind of client where this situation with how foreign jurisdictions would treat US superannuation can come into it. Okay. Joyce Grau writes, your heads is in front of the presentation as well as in a little box that I can move to the side. You're blocking some of the words. Well, that's no good. I don't think there's anything I can do about that right now. And I did check on that beforehand, but I will keep that a note for next time. So why are US persons still considered US tax residents if they live abroad? The answer to that is very simple, and it's to do with the tax treaty between Australia and the US. And it begins, as all US tax treaties do, with a clause known as the savings clause. And if we read this, as you can see the bit I've highlighted here, and by reason of individuals electing under domestic law to be taxed as residents of that state, and by reason of citizenship, may still tax its citizens as if this convention had not entered into force. There it is, right there. The US is saying, we don't care about this tax treaty. Our citizens and tax residents will not benefit from this at all. So that's why it matters. So if you're a US citizen and you're anywhere in the galaxy, you're going to be assessed, maybe not taxed, but assessed at least for taxation by the US. And that's very relevant when we come to talk about superannuation. So someone has written in a Q&A. Zoom have changed their setting. So perhaps the person that wrote it for Q&A, so I can't actually see that right now. Perhaps the person that wrote in that question could instead write that in the chat, and I can see that. Okay, so superannuation, what is it? Well, it's the primary pillar of the Australian retirement system, as we know. Superannuation, the aged pension, voluntary savings, of course, that would go into taxable brokerage accounts. It provides a tax-advantaged environment to save and accumulate funds for the purpose of funding one's retirement. The government has been very clear in the last couple of years that it is not a wealth accumulation vehicle. And there's two things. There's one actually in play right now. That's this Division 296 tax, this extra 15% on earnings above $3 million. But there's two other ones worthy of mention. There's the transfer balance cap. That's to say you've got a lifetime amount of 1.9 million Australian dollars that you can get into your superannuation account before it begins to lose that tax advantage status. So to me, the way I think of that is put on those blinders and save towards that 1.9 million. Then make sure your spouse is on track to do the same. After that, you're probably saving into your typical after-tax brokerage account. So that's one thing they've done. The other thing they've done, which we'll see a little bit later, is the Division 293 tax, not to be confused with 296. 293 is one where if you earn in excess of 250,000 Australian dollars, they slap you with another 15% contribution tax for a total of 30% for higher income earners making more than 250,000 Australian dollars. So it really reduces the appeal of super, but it's still, as I'm often saying to clients and prospective clients, it's still the best place to go if you are only an Australian tax resident, but you're probably not only an Australian tax resident, which is why you're on today's call. So let's keep going. Contribution types. There's three types of concessional contributions, and then the other major type is non-concessional contributions. As an easy way to think about this, we could compare this to the US with your traditional 401k and Roth type account. So your traditional 401k, it's a tax deductible contribution. That's like a concessional contribution. You're getting a tax deduction for the amount being contributed on the way in. Whereas your Roth style is more like your non-concessional. Non-concessionals, there's a limit on that, but you're putting after-tax dollars into superannuation. There's no contributions tax on it, thank goodness. So for folks moving back to Australia and getting rid of their US tax residency, I'm often saying this is the first and best place for you to go is to max out your super, because the government wants to see you self-funded. They do not want to see you on their payroll when you're in your senior years. Very, very different to the setup for Social Security. I get a laugh out of it, but I can imagine Warren Buffett with his walking stick going to the mailbox every month to collect his Social Security check. The Australian age pension is income and means tested. So it's very hard to qualify. You've got to be in a very restricted financial condition to even be eligible. Whereas US Social Security, as those familiar with my content and prior webinars would know, it's an earned entitlement. If you pay in, you get your benefit, and even better than that, and a big thank you to Australia for its loyal support to the US over the years, that due to the totalization agreement between the two countries, not only do you get your your Social Security benefit, but even if you relinquish your US citizenship or permanent residence, you still get your Social Security benefit, and you don't need to go back to the US every 6 months as those without a totalization agreement do. Okay, so here are your three concessional contribution types. The main type people will be familiar with is the compulsory superannuation guarantee contributions. It's actually picked up this financial year, which only began 3 weeks ago, to 11.5%. It's going to rise to a terminal value. I believe it's 12. So no doubt someone will write in and correct me on that, but it's going to hit a max of 12% coming up. I believe it's next financial year. There was talk of kicking that down the road a year or two. But in any case, if you're the max super contribution base is $260,000. So if you're making $1 million a year, firstly, congratulations. And secondly, for superannuation purposes, it doesn't matter that much because they're only considering that $260,280 for a max contribution of $29,932.20. Okay, there is a maximum annual concessional contribution of 30,000 Australian dollars in the current financial year. That's been inflation indexed, as we see in many different retirement systems. They increase the amount they're allowed to contribute, so they do in Australia as well, and they've bumped up again recently. So we're now looking at $30,000 is what may be contributed as a max on the concessional contribution side. If you don't make this $260,280, and thus your employer isn't already very close to maxing out your super for you, then you may make a salary sacrifice contribution. Give your employer and or super fund a call and say, hey, I want to make the most of what's available to me here. They'll be happy to do that, and that's going to be tax deductible to you. Unfortunately, in Australia, there is a contributions tax. So they're going to hit you with a fifth. They'll say, yes, it's entirely tax deductible to you personally. People hear that and they say, great, I'm going to save. I'm in a 45% tax bracket. I'm going to save 45%. Not so fast, because there's a contributions tax. And so the way they say this and keep a straight face is they say, well, it's not a personal tax to you. It's a tax to your super fund on your contribution. I don't really care what language they use there. There's a 15% contribution tax. So non-concessional contributions, as you heard me say earlier, that's equivalent to your Roth contribution. That's done with post-tax dollars. If someone is sitting on significant assets outside of super, their retirement is a major savings goal for them, then I would say, hey, take advantage of non-concessional contributions. There is a 3-year bring forward rule that may allow you to contribute up to 360,000 Australian dollars into super, and that would be nice to take advantage of if you have that situation. So a little more detail here about concessional contributions. As you heard me say a minute ago, there's a max of $30,000, as you see here in the second bullet point. It is personally tax deductible to you, but they're going to hit you with that 15% contributions tax. Or if you're lucky enough to make above 250,000 Australian dollars, then the government has their hand out for you to take another 15% for a max of 30% contributions tax. You know, that probably takes the cherry off the cupcake, but at least you still have a cupcake. If you're in a 45% bracket, there's no other option available to you to get a 15% uh, tax savings as simply as you would get by contributing to superannuation. Don't forget about the 5-year carry forward rule. This was introduced in the 2018-19 financial year. So this allows you to contribute to take advantage of unused concessional contributions from years gone by. For my client base, they largely see that because they were in the US and didn't contribute a penny for those prior tax years. They come back, maybe they're back in employment, they often are. And I would say, hey, why don't you make a big contribution into your super this year? Use your 5-year carry forward contributions for up to $137,500 in the current financial year, and your 360,000. And look at that, you're getting almost $500,000 Australian dollars into superannuation. And by golly, you could even do the same thing depending on your spouse's employment situation. You might even be able to get as much as that into their super as well. Someone has written in the chat, Alyssa here, can a very high earning person sacrifice into non-working spouse super fund? Yes, however, there is some detail to that. Australia, I really don't like this particular part of the tax code as much. It does penalize the breadwinning style household that you're describing here, Alyssa, insofar as in Australia, we don't have a tax filing status like we do in the US. US, you've got single, married filing separate, married filing joint, head of household, all these different tax filing statuses, and then a different tax rate that applies to that. In Australia, basically everyone's a single filer. And so you can really get hurt if you've got just a huge earning spouse and then a non-working spouse. But there are some ways of making spousal contributions, but they are somewhat limited. Mike writes in and says, if I have declared my super contributions as income each year, what is the US tax implication, especially if the US foreign excluded income allowance has resulted in low taxable income? Mike, what a great question. And I hope you stay tuned because in about half an hour, when I get to that section, you'll get the answer to your question there, but don't be afraid of prompting me again. Susan writes, is the 30% if over 250,000 income only for US citizens? No, 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 that's for Australian citizens. This is Australian citizens we're talking about here. Let's keep moving here. So concessional contributions, this is your 2024, 25 Australian tax rates. In a completely different presentation and topic, I've spoken about non-residence tax rates and why I'm very bearish about owning so-called investment real estate when you're a non-resident. So Australians often do that as a hedge to come back. They don't want to be priced out of the market. But I would say you're better off keeping your money, especially if you're in the US. Please see last month's presentation. I spent an hour talking about this. The expected returns in the US stock market versus the Australian real estate market are vastly different. And the US stock market over the past 20 years, as I showed, someone even wrote a comment in YouTube that I answered a few weeks ago, is more than double the pace of what we've seen in Australian real estate. So while Aussie real estate has increased rapidly, you'd get an even better return, significantly better return, when looking back at the past 20 years. And guess what? You wouldn't be hammered by these non-resident tax rates. Okay, let's keep moving forward. Katrina writes in, if you have two US citizens, if you have two citizens, US and Australia, and decide to retire in Australia and relinquish citizenship in the US and have a Roth in USA, do you still pay tax on the Roth? Well, let me think about that. If you relinquish that, Katrina, that's a Heart Act question. So we'd need to look at this pretty detailed planning you need to do with your exit. So if you relinquish, then no, you don't need to worry about the US treatment of your superannuation account, but you do need to worry about the Australian treatment of the Roth account. We would take care of that planning as you got closer to that exit date, and the primary tax whip, if you will, would be that exit tax, assuming you meet one of those three tests that they have for the Heart Act, namely being, do you have a global net worth in excess of 2 million US dollars? Did you have an average federal tax liability, not income, tax liability exceeding 185? I believe it's 185. It's up to it's around that number. It was 178 last year, but I think it's 185. Did you have an average federal tax liability of 185 average over the last 5 years? And are you current with your state and federal taxes as of the past 5 years? If you meet one of those tests, you're going to be a covered expat and you may be assessed for an exit tax. So that's the first thing that I would be looking at, and then would be looking further down the line to see, well, what's the Australian tax of that Roth? Um, but that gets a little more complicated. Okay, so non-concessional contributions, there's a $120,000 contribution limit, as you've heard me say. Previously, it was 110. If you're under age 75, you're able to make those contributions. There's that 3-year bring forward rule I mentioned. And really, as I said earlier, if your primary goal is saving for retirement and you're well funded for your other goals and you've got excess cash sitting around, this is probably the best place for it. Or for your spouse, as to that questioner a minute ago who was asking about, it might have been Alyssa, asking about contributing to a spouse's situation, superannuation account. When can you access your super? Well, let's talk about that. When you hit your preservation age and a condition of release. So preservation age for practically everyone under the age of 60, that is going to be 60 going forward. If you're born after the 1st of July 1964, it's going to be age 60. So, and if you're born before that, you can see this chart here kindly provided by the ATO. Let's go to the condition of release then. So here are the three main ones. This is not an exhaustive list, as I note here, but for 95% of people that I'm going to talk to, this is what you're going to see. So if you retire and you're over the age of 60, really between the age of 60 and 65, if you retire from that age, you can access it. So you've hit your condition of release. Sorry, you've hit your preservation age, you're over 60. So tick that box. And then the next box tick is not planning on going back to work. Congratulations, you can access your super. Next is beginning a transition to retirement income stream. We don't really get into those all that often, to be honest, because we just don't. We don't see the point. And maybe the kind of clients we're working with are not in that particular situation. But one we do see a lot more often is this turning 65. So 65, I've put together a diagram that I'm going to show you at the end of this section that really spells this out for you, and I'd encourage you to screenshot that if you'd like. This was, by the way, previously a premium webinar that I ran in August of 2022 as a fundraiser for the folks in Afghanistan, given the chaotic US withdrawal at that time. So that was a charitable contribution made from that webinar, and this is a lot of the same material that we have from that. Okay, three important ages. So between preservation age and 60, you can access your super via a TTR as an income stream. Even if you're still working, over 60 and retired, you can access it because you're over 60 and retired, or 3 if you're over 65 and not working at all. Okay. Before I get into talking this through, I see another chat's come through. Mike writes in, is a 401k tax deductible or merely tax deferred? Well, that's a brilliant question. Better than it's a brilliant question. I believe traditional IRAs are purchased with after-tax dollars, are tax deductible. So traditional and 401ks are tax deductible. So that's to say you contribute to that, it reduces your taxable income in the current year. However, if you're a US citizen or tax resident and you stick around until retirement, withdraw that money, then you're going to discover that it is, in fact, as Mike alludes to in his question, is most accurately described as tax deferred, because that money that you pull out is going to be ordinary income taxable for the US tax resident. Where it's not is for the returning Australian or the American that gives up their citizenship or permanent residency. Why? Because The ATO then looks at this account. It's the flip side of what we're talking about today in this presentation. The flip side is, well, how does the ATO make sense of a 401k or traditional IRA? And the answer there, previous webinars, go check that out. But there are ways of doing it such that you only end up being taxed on the Australian side. And if you do it really well, then you can avoid or vastly minimize that tax exposure, Mike. Okay, so superannuation tax treatment. This is your summary slide right here. On the contribution slide, on the side, not slide, on the contribution side, you're getting a personal tax deduction of 15% contribution tax, assuming you're making under 250,000 a year. And another one of these rotten rules that they have in Australia, the US does it too, is that's not inflation indexed, that 250. So more and more people hit that limit every year when they get a cost of living adjustment in their salary package. Next, growth. In the accumulation phase, it is tax advantaged. Yet again, this is the best place to be for most people saving for retirement. Why? Because your interest, dividends, and short-term capital gains are taxed at 15%. Your long-term rate is 10%. That is going to be much better than the vast majority of folks in their prime income earning years, where the long-term capital gains rate in Australia is half of your ordinary income rate. So someone in a 45% bracket is going to be 22.5%. I prefer 10% over 22.5. And in the distribution phase, this is why I think superannuation is and the University of Melbourne and Mercer Consulting agree with me on this. Superannuation is actually a really good system for Australia. It works incredibly well for helping retirees self-fund and take that responsibility off the government. And so it works pretty well, but it's not a wealth creation tool. So they have this limit, that 1.9 million. Next in distribution, assuming you've hit your preservation age, hit a condition of release, you're getting it tax-free. What could be better than that? Between you and your spouse, I think I had this number on a previous slide. If we were to assume a 4% distribution rate from a $1.9% million superannuation portfolio, you're pulling out, I believe that's $76,000. I can't do that 4% math at the top of my head. But it's going to be very close to $80,000 a year, maybe 78,000 even. Times two, you're doing all right, especially if you've paid off your mortgage. Australia, thank God, they don't have property taxes like they do in the US. Victoria apparently is looking at introducing those, but in most other states we don't have them yet. Okay, so you might like to take a screenshot, and hopefully my head's not in the way of this. But here's what we have. If you're an Australian citizen or permanent resident, where do we start? Have you met a condition of release, i.e., are you over 60 and retired? Or are you over 65? So have you met a condition of release? Yes. Okay. Have you reached your preservation age? Yes. Okay. Are you over 60? Yes. Still working? No. There's that checkered flag. Congratulations. You can access your super. This one, it didn't really work. If you're over age 65, there's the checkered flag already. It doesn't really matter what you do. But here are the other conditions that you'll see. So I actually think it's that simple. You know, for most people, are you over 60 and retired? Great, you can get it. If you're over 65, you can get it. Done. Now, the people that write in the questions are the people that obviously have a different scenario to that. For the temporary residents for whom this webinar is not intended for, they have a very unfortunate situation where they have these departing Australian superannuation payments that could be as horrible as 65%, as shocking. So it seems like they're almost clawing back income from these temporary workers in Australia, but that's how the rules are. Tax treatment of an Australian superannuation account by the US. This is what you all came for, folks, but I needed to get that out beforehand before we talk about how the US works. Okay, retirement tax concessions are country specific and are determined by that tax treaty. We can just cut to the chase here. There's nothing in the Australian US tax treaty that deals with super, and part of that is because when it was originally signed in 1983, superannuation didn't exist. And thus, that's you might say, well, what about in 2001 when they amended it? Well, true, they still didn't address it at that point in time. There is a movement happening right now by the Democrats abroad to have this looked into, and I'd encourage you to write in and give your support for streamlining this, because right now it really is a horribly complicated and unfair situation that dual citizens and dual tax residents find themselves in. Amy Soberg writes in, for your information, for participants to change their Zoom view. Oh, here we go. Go to the top renter, right, I guess, probably top right is what she means, um, of your screen. Click on view. Yeah, top center. There we go. Top center. Okay, very good. Thank you, Amy. Appreciate that. That's helpful because I only tried this new view today, and I appreciate that feedback. So, what is Australian superannuation under US tax law? It's really going to be one of two things. It's either going to be an employee trust under Internal Revenue Code Section 402B, or it's going to be a foreign grantor trust. It's not a non-qualified plan. Okay. So US treatment, what is a foreign trust to begin with? It's essentially any trust, as far as the US is concerned, is a foreign trust if it fails to meet either one of these two conditions. That is, a court within the US exercises primary supervision over the administration of the trust, not the case with superannuation, or one or more US presidents have the authority to control all substantial decisions of the trust. Well, it's really that first one that knocks out superannuation right there, and it's we can veer in the direction of it being a foreign trust just by knowing that. So a foreign grantor trust has the ability to revest title to the trust assets. They can control distributions, or the distributions are solely for the grantor and their spouse, like a self-managed super fund. And thus, it is the case that for any self-managed super fund, it is definitely going to be treated as a foreign grantor trust. For the globally mobile, I haven't done any webinars on this, and I'm not planning on doing any webinars on this, but self-managed super funds are not a good idea at all for the globally mobile. Why? Because you need trustees and directors that are Australian tax residents for a start. And if you're not in Australia, you ain't an Australian tax, you're not going to satisfy that condition. And then the second thing is you're going to be treated with this foreign grantor trust tax treatment. And I'm getting to what that tax treatment is in just a minute, starting right here. But I've got a much better table coming up in just a moment. So contributions are a US, it's not exactly correct. The way that a foreign grantor trust works is it's mark-to-market taxable. So as of January 1st, what was the value of the account? Let's look at it again at December 31st. Whatever increase that's happened in that value of the account, be it through contributions or through growth, is going to be ordinary income taxable to you in your current financial year. Why is that less preferable than the employee benefits trust that I'll talk about? Well, here's the reason why. Most folks that I see that come to the US are in their prime earning years. They're already in a higher tax bracket to begin with. And so to be adding more income at that higher marginal rate is not desirable. That's essentially it. The benefit that does come to the foreign grantor trust is that your basis in the trust is stepped up. And so at distribution time, namely at retirement, you're able to withdraw those superannuation funds and not pay additional US tax on that. An employee benefit trust would not have that, wouldn't, I had to use the word again, would not have that benefit. You have to define the basis in the trust, and then the distributions are going to be taxable. But if you're clever, maybe you're not going to be a US tax resident at the time you take the distribution. Okay, so here's the decision tree followed by another slide where I'll talk about aspects of control that helps you determine whether your superannuation account would be considered an employee benefit trust or a foreign grantor trust. The one I always start with, and for some reason people get a little bit confused by this, is has the account holder contributed more than 50% of the account balance? Now, that is personal concessional contributions, not employer superannuation guarantee contributions. So most folks that I talk to, I would say probably in the order of 80% would say, hold on a minute, no, my superannuation account balance was entirely due to superannuation guarantee contributions. Maybe I made some salary sacrifice contribution or some other personal contribution, but it's definitely less than 50% of the account balance because remember, there's also account growth in there as well. Someone's written in on the chat. Scott, what happens if your super falls in value? Bummer, Scott. Unfortunately, it's not tax deductible. So this is yet again why we don't like these foreign grantor trusts. And you're absolutely right. Yeah, it could move against you, but tough luck. It's not going to be deductible for you. Okay, has the employee contributed more than 50%? In most cases, no. Does the individual control the operation? That control really should be italicized and underline the operation of the trust. Control, what does that mean? That means a lot of things, and it's not so clear cut. Do they control the operation? Let's assume no, they don't. Did the trust fail to be exempt due to the minimum participation standards or the participation rules? And here's the Internal Revenue Code sections to go and check against. And we'll say, no, congratulations, you got an employee benefits trust. And we'll talk about the taxation of that. I've got a table that walks us through this in a very handy way coming up in just a minute. Otherwise, if you have contributed more than 50% or you demonstrate material aspects of control, as are indicated here, and we'll get to that in just a second, you're looking at a grantor trust or a discriminatory employee benefits trust, which I believe is the same tax treatment as the foreign grantor trust. So what are those elements of control? Individual is the appointer and has the power to replace trustees. Well, what does that mean? You can't call up Sun Super or Australian Super and say, I'd like to fire the trustee there. So that's not what they mean, but they say, can you roll it over? Oh, yes, you can. That's easy to do. And if you do roll it over, you could be creating problems for yourself. And I'll address that when I get to the FAQs a little bit later. But there's the answer, is you can't roll it over when you're a US tax resident because it's deemed to be a taxable distribution. Do you have ultimate beneficial ownership of the trust income or capital? Yes, but that factor is sort of not really considered so much because you could say, well, yeah, but so do, millions of other people that are with Australian Super or CBUS or whoever. Do you exercise investment decisions? Well, if you're in the default investment options or they've got a very limited set of investment choices, not really. You could say the chief investment officer of that super fund, they exercise investment decisions, but this is another way in which your self-managed super fund comes unstuck from the US side is you absolutely have investment discretion if it's a self-managed super fund because you are very likely, at least, you are the trustee and you're the ones calling the shots as to how that's invested. You or your spouse have the power to vest the title of the trust assets, realize the value personally, or transfer ownership, distribute. Again, yeah, that's not factored so highly. Can distribute or accumulate income for your benefit or your spouse, or are highly compensated as defined by Section 414Q of the Internal Revenue Code. So you can see this is why intelligent, successful international CPAs can have different opinions over what you're looking at. Is superannuation employee benefits trust or is it a foreign grantor trust? I come to the opinions shared with you here today through my dozen years of experience talking with international tax attorneys and CPAs, and this seems to be the standard way of viewing things. But when it comes to determining if you have an employee benefits trust, what that basis is, that is very quickly a referral off to one of these CPAs because we do not do tax returns. And this is really the bright red line as to where the financial advisor gets involved and where the CPA handover occurs. This is the table I was talking about. I think you'll find this very helpful, what you're seeing right here. So what we've got with the superannuation account is the ATO treatment summarized in the first column. That's everything I was talking about in the first half of today's presentation. So concessional contributions are taxed at 15%, assuming you're not subject to Division 293, which is an extra 15%. The growth is taxed at these concessional rates you see here. And in retirement phase comes out tax-free, assuming you are below that 1.9 million transfer balance cap. Now, what about an employee benefits trust? This works well for folks that are just spending a limited amount of time, and that limit could be many years, even many decades in the US. Contributions are taxed as ordinary income. Not a big deal if you're not making contributions, right? If you're in the US doing your thing, living your life, you don't care because you're not making those contributions, so it doesn't matter. Earnings are tax deferred. That's also good because you're in your prime earning income years. You don't want to add to a problem of your US tax bill. Retirement phase, uh, that's where that's where things could get tricky for you. Your corpus is tax free. Figuring out what the base corpus is the Latin for the body. Figuring out what the basis is on that account is going to be tricky. You could work with your international CPA on that. The gains are taxable at ordinary income marginal rates, not pretty. That's going to be nasty, and you're going to need to work with a CPA to figure that out. So when you distribute from your superannuation account as a U.S. tax resident, if you are still one at retirement, this is where this is not so great. You've suddenly got to determine the basis, and then everything that gets paid out is a pro rata amount that's ordinary income versus a return of capital and is not taxable to you. So we don't like that so much at distribution time. IRS treatment of a foreign grantor trust. Okay, so contributions are taxed indirectly by determined. This is what I was saying a minute ago. This is the difference in the vested accrued balance from the beginning of the tax year to the end of the tax year. So you've got your contribution, your growth, whatever the total of that is, slap it on your earnings for the year, and that's what you're looking at. The good news, however, to the foreign grantor trust treatment is that when that money is withdrawn, you've already got a basis that's been determined in that trust, and so the distribution would be tax-free. Generally speaking, I'd say I steer my clients more towards the employee benefits trust when it's clear that they're not going to be US tax US tax residents at retirement. Um, and then otherwise, with a foreign grantor trust, it's normally the facts and circumstances would dictate whether they are going to be subject to that treatment anyway. All we can really do on the planning side is tell folks don't contribute too much, the more than 50%, don't roll it over, don't do this, don't do that. And fingers crossed, hopefully we don't become a foreign grantor trust while you're still in your prime income earning years in those higher income tax brackets. Okay. Foreign investment company, this is a PFIC question. So passive foreign investment company status for these different types of US trusts. Well, bad news for the foreign grantor trust. You lose the PFIC exemption. This is very bad news indeed because the PFIC rules are nasty. I'm sorry, just going to take a second. Stephen and Mike have written in. Steve, if you retire but don't take distributions from super, is it still taxed by the US? Well, is it an employee benefits trust or a foreign grantor trust? If it's an employee benefits trust, then I would say, and you don't exercise control, then you're good. I'd say you're not going to be but I'm just going to read your question again. If you retire but don't take distributions from super, correct. If you don't, is it still taxed? No, it's not taxed until such time as you begin taking those distributions. And by the time you do take the distributions, hopefully you might have given up your US status, in which case you don't have this problem to worry about again. Okay, Mike, thanks again. Yeah, I remember you wrote earlier. Again, if I've declared my super contributions as income each year, what is the US tax implication? Especially if the US foreign excluded income allowance has resulted in low taxable income. I don't think that changes anything, Mike. That's you could still, if you're in Australia, you've been making your super contributions, You are below apparently the foreign earned income exclusion amount, so it's been taxable income. That doesn't actually make a difference to the treatment of employee benefits trust or foreign grantor trust. But what it does do that will be beneficial for you is it steps up your basis in that account. So that one, I think I would punt to a CPA, to be honest, because you're going to be in a better situation than someone who has no basis, but exactly what your basis is, and thus what the pro rata ordinary income tax amount, assuming it's an employee benefits trust still, versus um, the basis that would have to be determined in a basis study by an international CPA. But thank you for the question. Okay, so we're talking about PFIX here. Whole topic of another webinar that I've done before. I haven't spoken about it in a couple of years because, to be honest, folks, this does not get people very interested. Gets people very fearful, and they tend to tune out and avoid it for that reason. But a PFIC, a passive foreign investment company, is a catch-all rule that came out in the 1986 Tax Reform Act, and it was intended to avoid tax-sheltered foreign mutual funds mostly. In Europe, what they could do is they could roll up and not distribute earnings for years and years and years. The US mutual funds don't have that benefit, and so they came out with this rule as a way to whack the European funds and avoid what was better treatment than what the US gets. And the way they look at that is this. They say, if you've got a foreign managed investment where more than 75% or more of its income is passive in nature, that's rents, interest, dividends, etc., or 50% or more of the assets produce passive income, you're staring down the barrel of a PFIC. And that is bad news. Why? Because the most common treatment is you see down the bottom there, the do nothing, the default is excess distribution treatment. It's throwback tax. You get taxed at the highest marginal ordinary income rate for every year you held the investment. It's a shocking tax treatment. You don't want it, and that's what's going to happen to you if your super is treated as a foreign grant or trust. The investments within it could be PFICs. They almost certainly are PFICs if they're an ETF or a managed fund. The only way that I know of to get around that is to invest in individual companies. And if you're smart and you had a self-managed super fund and you were a dual citizen, then what you would do is you would own individual stocks. And what I mean by individual, the Telstras and QBEs and Wesfarmers and things like that, not recommending those stocks. I'm just saying those are examples of individual stocks and not ETFs or managed fund. I assume a PFIC is not if you have a trust that is active income. Uh, I can't really make sense of that question, to be honest, Katrina. So I'm going to keep going. All right, frequently asked questions on this topic. As a US tax resident, is a rollover to a different superannuation account a tax limit? Why, yes, it is. Remember, not in the eyes of the ATO, but in the eyes of the IRS, because the super was never a tax qualified account to begin with. Simple. Next, can I make this is an oldie goldie, this one. Always get asked this, and the answer is always the same. It depends. Can I make a concessional contribution to super as an Aussie abroad? Well, possibly, but it mightn't provide the tax benefit you hope for, and it could even tip the scales to your superannuation account becoming a foreign grant or trust, which we really don't want. So the majority of the time that we see this question, it's from folks that have got Australian so-called investment property, um, and the maybe very, very, very rarely will they have positive income, especially given interest rates as they are. But it's possible someone might own a property outright, have bought it many years ago. It's cash flow positive. Someone they made at the barbecue after a couple of beers said, "Well, why don't you contribute to super? You know, you get a tax deduction." What a great idea. Well, no, because that income is still taxable on the US side. Uh, on the Australian side, it is tax deductible. That is true. There's no denying that. But you're still paying, you're actually just not getting the benefit you think you are. Could it still make sense? Yes. And here are some conditions that I would want to see to be in place for it to make sense. You're in a US state like Washington with low or no income tax, Washington, Texas, Florida. you're in a lower US tax bracket than the prevailing non-resident Australian tax rate, which I showed you earlier, starts at 32.5%, remember, and works its way up 37.45% from there. And will remain so even when including the additional Australian sourced income. Uh, Typically, the amounts that we're seeing for Australian sourced income is not that much. Maybe the investment property makes you $30,000 or something like that, or 30,000 Australian dollars. So it's more like 20,000 US. Probably not going to tip the scales and push you into a higher income tax bracket, but this is a check we want to make sure of. Next, will the inclusion of the concessional contribution amount, your personal contribution to your account, still equal less than 50% of the account balance? Why? Because that would otherwise become foreign grantor trust. And you plan to give up your US tax residency at some point in the future, which basically means you're planning on coming back to Australia. So if all of those conditions held, then I'd say, yeah, hey, that's a great idea. But the amount you saved is still not that much because it's going to be the difference between the US tax you paid and the Australian tax you saved. Better than nothing, and I would, certainly take that amount if it was available to me or my client. Should I contribute extra to super as an American in Australia? Another oldie goldie. We get asked this all the time. Well, super is mandatory for Australian tax residents, so we really need to ask this question differently. Is it a wise idea for me to make personal concessional contributions to my super beyond what my employer must contribute? For the non-US tax resident, i.e. the pure Aussie, yes, it definitely is. The mixed nationality couple, again, the topic I did earlier this year. If one of you is an American tax resident and one of you is not, then you'd want to be maxing out the non-US tax resident. However, coming back to this question, to some degree, it depends on your legal residency status in Australia. Temporary residents, we don't worry about them too much. Um, let's look at the US citizen and permanent resident situation. Maybe it makes sense, but not likely. The viability of making concessional contributions depends on two things. As I was saying just a minute ago, with a very similar question, the difference between your US assessable income and your Australian income, with Australian rates coming on higher and earlier, it's quite possible that making a concessional contribution still wouldn't be taxed by the US. And actually, we do see that a lot of the time. The foreign tax credit generated covers the super contribution. So that is how, and I hope to folks hear that particular point. That's how it's possible when you hear CPAs say, and I said it earlier, it's how something that seems like it can't be true in both ways, but it is. Contributions to super are US assessable income, but that doesn't mean that you actually end up paying tax on it because the foreign tax credit generated by you paying your Australian income may and very often does cover the extra tax deducted amount that goes into your super account. So it's assessable. Do you end up actually paying tax on it? Probably not. Second point here is in addition to a range of other factors that may tip the balance to foreign grantor trust treatment. And now you know what they are. They're the control factors. But the easiest one is, did you contribute more than 50%? So if you happen to be having this conversation with someone, whatever the context, you could either point them to this webinar because it's a lot of detail to remember, or say to them, it's really not as simple as that. And they could say one of two things. They could say, thank you for your advice. I appreciate that. You've listened to a professional and not a talking head on Facebook or TikTok or wherever. And secondly, I realize this is very complicated, and I would probably need to get a professional consult. Self-serving of me to say that, I will admit, but it is true. Actually, there was a third thing I was going to say. Let's just go back here. The third thing I was going to say is, having just returned from Kakadu last week, this is fresh in my memory. There was for many years a thought that there's no speed limit in the Northern Territory. You could go up there and they had a cannonball run once in the 1990s. They ran it once and there was a crash and someone was killed, so they canceled the whole thing. But there was a rumor that there was no speed limit up there, just as there is. Some people will say incorrectly and wrong that there's no you can do these things. There's no problem. It's not true. It's just as the case with the speed enforcement in the Northern Territory, it's that there isn't a great amount of enforcement on the IRS's side to do with this. However, with the investments that they're making in artificial intelligence, and with how much better these databases are getting integrated, I think it would be a foolish proposition to not be in compliance. And so the people that say, I've been doing this for years, Bob, Harry, Jane, Jill, you can do this. I'm telling you, I've been doing it. That may be true. I have no way of saying that someone who says they have been doing things uh, incorrectly for years has not been doing it. They may have. They just haven't actually been caught yet. That's the difference. So it's a risk management um, issue. As an American, Australians are a way for me to avoid having to contribute to super. Yes, and this is the last slide I have here for you guys today. If you're not deemed an Australian tax resident, well, what does that mean? There is a tiebreaker provision in the tax treaty to determine who is actually a tax resident of Australia and who is not. There are a small number of people on today's webinar that would fall into this category. And that is if you were in Australia for up to a maximum of 5 years and you had closer connections back to the US, you said, my primary residence is there, I still have kids there, I have a dog there, enrolled to vote, uh, health insurance, all that stuff. If you said, my closer connections are definitely back to the US, I don't have Australian bank accounts, I'm renting here, I own a business, but it's registered in the US. If all of these things fell into place for you and you said, this is my situation, my closer connections are unequivocally back to the US, then you're not deemed an Australian tax resident and thus wouldn't have to bother getting embroiled in this in the first place. Werner writes in and says, as a dual citizen planning on relinquishing Aussie citizenship, I don't see that often. Planning on relinquishing Aussie citizenship. That is the only way to close my super account and transfer to the US. Can you just briefly speak to what to consider there from both? Now, I had a funny face there when you said Aussie citizenship. I people, thousands and thousands of people every year relinquish their US citizenship, not for political reasons, for tax reasons, because of this citizenship-based taxation I began speaking about at the top of the presentation. Very rarely do you see folks relinquish their Australian citizenship because there's no tax disadvantage to it that I can tell. So that is the only way to close my super account and transfer to the US. Well, not really. If you meet the preservation um, conditions and sorry, the preservation age and conditions of release, then you can get your super account out, no sweat. Can you just briefly speak to what consider there from both the ATO and the ATO? Well, to be honest, Werner, I already did, and that was what I was saying there. You don't need to relinquish your Aussie citizenship to get your superannuation account balance. You merely need to be above 60 and retired or above the age of 65, and you'll be able to get your superannuation account out. How will the US tax that? Well, that's what the second part of today's presentation was to do with. But thank you for the question there. So, what about lost super? Search for lost super. It's not unlike going to the individual states in the US and searching for lost money there. Always a good idea to do if you're leaving the country and moving state. And get a MyGov login. And you can find it there. If you want to find out more about anything I've mentioned here today, then come to our website, arete-wa.com. We've got our webinars up here. You can also go to the YouTube channel as well. We've also got white papers, and I'm pleased to say we're really getting back into writing blogs and white papers. So we've got one coming out which will be on last month's topic, so you can read that if you'd rather read that and not watch the webinar. We've also got the key financial data sheet for Aussie expats in the US and Americans in Australia available there. Next month, talking about unlocking global equity, maximizing executive compensation across borders. How does equity compensation vest when you move across countries? Bit of a niche topic, I understand, but it is one very relevant to a number of my clients. Questions, please write them in. Andrew's jumping the gun here, and I'll get to his question first, but please do write your questions in now. So, Andrew, I understood that if you have superannuation that's classified as an employee trust, then you also then pay US tax on the annual value increase of your superannuation if you're a highly compensated employee. Is that correct? Gosh, Andrew, I will not pretend to know the answer to that one. That is a very, very good question, and I can't answer that one. I'd have to look into that. It could be the case. We might be able to figure it. Got to run. Thanks, go, Camelot. Okay. Let's see. I'm equally despondent about both presidential candidates. I might, maybe not equally, but um, it's not a good situation we find ourselves in. But people don't pay me for my political opinions, so I generally don't mention that only because Scott wrote "Go Camler" in there. But if we go back to this diagram here, this might provide some guidance on that. Is the individual highly compensated? It's considered a discriminatory employee benefits trust. So based on this, it would say yes, this was put together by an international CPA. That's what we're looking at there. So Andrew, the inclination would be yes. David, does Australian super impact Social Security payments because of the WEP? Yes, it does. And I've mentioned that in previous webinars to do with Social Security. There's a lot of detail on that one. Please, anyone that wrote in the Q&A section, oh, I can now see that. I can now see those questions now that I'm not full screen. So David, to answer your question, yes, it does. They ask you for your balance, and then they use a table to determine what monthly pension equivalent that is, and then they reduce your Social Security benefit as a result. Are there ways of planning for it? Yes, topic of a different webinar. Margot, thank you. Write to me separately. This was a premium presentation. Typically, we don't make slides available for public webinars like this, but I appreciate all the support you in particular have showed, so I'd be happy to. Katrina writes, I understand that if you're a citizen of the US and have a Roth in the US, blah, blah, blah. I think I answered that already. Oh, hold on. Mike writes in, doesn't the HCE amount change with it would, yeah, yes, it does. So yes, that would be a factor also. So the highly compensated amount, um, I looked that up earlier in preparing for today's presentation. It's something like $155,000 US dollars, that is. Yeah, that's the one. Right, right, right. So yeah, yeah, it's a tricky one. Um, but anyway, thank you for the question. Nancy, good to see you here. As always, your webinars are sensational. I appreciate them. Getting closer to moving back to Oz. Granddaughter's growing up fast. Rory's earning my trust too. Good to meet him. Thank you for that referral to Rory, an estate planner in Minneapolis, who I met in person a few months ago when I was back there. Hey everyone, thank you so much for all your support. Please don't keep me a secret if you know of anyone who you feel needs professional assistance, or if you yourself needs professional assistance, then I'd be happy to provide that assistance. Thank you so much and have a wonderful rest of your day. Bye-bye.